Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Since making a significant high on July 11th, corn appears to be in a bit of trouble. As the week closed out last week, an island reversal did post, and on Monday the market gapped down and has yet to recover from that gap that we've seen. From here, what we can potentially anticipate is a one-to-one correspondence off of that July 11 high down to the most recent low. A one-to-one correspondence of that move would land at about 357, which is very close to that 360 mark that we've talked about as a potential target for a downside movement in corn. Right now, the weakness continues to persist, and support perhaps may not happen until it gets to about the 360 to 357 number. And if it breaks below this 357 number, continued weakness is anticipated for the next several weeks. Volatility-based support was formerly at the 368 level, but since then the market has collapsed and fallen below that number, then we can see support at our 270-degree mark at 363, and volatility-based support has also made a shift, coming down to about 356 with the possibility of running down to about 350. Both of these areas now tell us that the market stands to continue to move lower, where again support could fall in the 357 to 360 area. The December contract looks very similar to that of the September contract. One of the differences is the most recent low that was made in the December contract has yet to exceed the June low, whereas the September contract did in fact surpass the previous low. We're looking currently at potential support sitting at the 374 half number. But in all likelihood, we anticipate that this quartile level will be broken and the market could very well continue lower. Our next timeline of demarcation sits at about August 10 to August 11. And on a couple of these charts, we've seen the same date recurring, and it happens to coincide with the upcoming USDA report. One standard deviation below the point of control sits at 364, and this is perhaps a good target threshold for this market to hit on its way down. Interestingly enough, that 364 number happens to coincide with our 270-degree mark at 363 half. And so again, we like this potential target for this market to find potential support. One item that we'd like to bring to your attention is that the market has hit a support resistance level where the market could bounce for the next couple of days. And once again, we do have that August 10 timeline coming in very close, where the market could very well make a reversal once it approaches this timeline. What we would then be looking for is for the market to potentially either move sideways or even continue to move a little bit lower going into this date before being able to find a potential reversal, or it could in fact accelerate on the way back down instead. The last couple of weeks have been particularly hard on both corn and wheat. Soybean, on the other hand, has only suffered about a 50% retracement of its recent movement. The other two markets have given up all of their movement pretty much, or are very close to retesting those areas. And so soybean perhaps continues to be the strongest of the three, although if it continues to break below this 969 to 970 area, it could very well fall prey to continued weakness as well. The last couple of days, it has found very good support coming in at the point of control number of 963 3/4. And as long as it's able to hold here, we think a potential bounce is possible. Overhead, we have the quartile sitting at about 983. And so from here, if the market is able to make its way up this week over the next couple of days with what's left of the week and break back above 983, then it could very well get some legs moving into that August 10 USDA report. The recent support that we've seen the last 2 days coincides with our 180-degree mark sitting at 966 half. But part of the concern that we are also seeing here are some subsequent lower highs that the market has been printing. In the event that the market makes a bounce and makes one more subsequent lower high and fails from there where it breaks below the 180-degree mark one more time, we could see a very strong move that does in fact go back to test the previous lows. So the current movement from which we are right now is very key as to whether or not we're able to get reasonable follow through to the upside, or if the market does in fact fail back down and tries to retest previous lows. The point of control for the November contract is at 963, and we can see the market is just above that number here, about 10 cents or so. We did find support sitting right up against our quartile level near 975, and from here it's simply the same movement that we're seeing with the September contract, where we would ideally be looking for the market to avoid making one more subsequent lower high and instead being able to find some strength to turn back up again. If that's not able to occur, this too can fall prey to continued weakness. Volatility-based support for this contract formerly sat in the neighborhood of 892.5 to 904, and just below that the market also was looking at 880.5 to 859.5. What you'll notice in this chart is that the volatility-based support bands are now starting to make a shift to the upside, suggesting that a higher volatility-based support number can in fact establish itself, and the market from there would find reasonable support. This tells us then that as this market's making its way down, as volatility-based support looks up to reach into this market here, our sinusoidal wave could very well be potential support for this market coming into that USDA report, and from here we could potentially find some legs. The wheat complex continues to struggle. Most importantly, we can see a continuation pattern that established itself on the way down. From here, what the market basically did is gave us a very strong leg into this movement and gave us a mirror extension on the other side. As the market has been moving down, it's been breaking key support levels all the way down. One of the key levels that it did break recently was the point of control number at 462. It broke that over the last day or two. And from here, if the market continues to find weakness, its next key level that it would be looking at is at about 431, which would be essentially a retest of previous lows, giving everything that it's done since April back. From here, we don't anticipate that the market's going to have very much strength going up. And even if it were able to bounce up from here, instead of being able to actually reach previous high, at best we would anticipate now what we would consider a failed wave 5 movement, where the market maybe can make its way up about halfway and retest this quartile level before turning back down again. By the looks of it, the market continues to be broken here for wheat, and we anticipate lower prices from here. From this vantage point, we can see a small bounce at volatility-based support that the market did create for itself for about 5 to 7 trading days. After having bounced from here, the market continued on way back down, and our next level of volatility-based support now sits at 448.25. This is perhaps where the market could very well find a pause, although the region or the band for that potential bounce ranges between that 448.25 to 433.25. And so this is where we're looking for the market to find its next potential support area from which it can potentially trade sideways. And from here, we would then be looking for a potential catalyst from the USDA report. The December chart's not quite as broken as the September chart is as far as the Elliott wave progression is concerned. We can see the wave 1 high coming in, and the market right now is essentially testing right at that number there. So from here, if the market were somehow be able to turn back up from this level here, we would still anticipate a failed wave 5 coming in. Perhaps that comes in at either one of these quartile levels at about 515 to 518, which would coincide with 1 standard deviation above the point of control. And if it finds strength beyond that level, then we're looking at the next quartile level that sits at about 562. As far as December cotton is concerned, the movement that we saw that found support up against our 66.4 number essentially is starting to look like it was accumulation. In fact, we can see a potential continuation pattern that established itself after that consolidation, which lends itself to potential strength to the upside. We had a key demarcation timeline of August 1st. The market posted a very nice bar on that day, and we see very nice strength coming into the market from that point. Our next target threshold sits at about 71, and if this market's able to get above 71 this week and hold, we anticipate continued higher highs and higher lows potentially for this contract. A couple key observations that we have for this contract in particular. Now that we are above our key 50% threshold, the potential for this market reaching up to about 72 is now higher in terms of our internal metrics. The market's now showing some very good strength in conjunction with testing our 180-degree mark. All of these factors are pointing to potential continued strength for this market coming in. And once again, if it's able to clear through the 71 area or so, we anticipate that the market could very well start producing higher highs and higher lows. In the coming weeks, if it is in fact able to print several closes above the 72 mark on a consecutive basis, we anticipate that a retest of previous highs from March 2nd have a very good chance of being reached once again before this contract comes off the board. The US dollar continues in weakness, and it's making its way very close to our next target threshold of 91.95. The weakness that we've seen in this currency remains consistent, and we do like this potential target as an area where the currency can potentially find some support. From here, the market can find a potential leg up, but the continued weakness overall for the long term appears to be something that may be in place for some time. We're really liking what we're seeing here with the September crude contract. We've long been given a projection of a potential target of 50-50. The market came very close to hitting that over the last 2 or 3 days, and looks like it's again starting to make its way back up again. If and when this market's able to close above this 50-50 mark, and if it's able to give us 2 or 3 consecutive closes above that mark, we anticipate that the market could very well touch 52 and change and possibly as high as 54, and a new trend to the upside can in fact be in place. As you can see from the low that was posted back on June 21st, we suggested that this low was perhaps a low of significance. And had you been following our weekly market updates, you would have seen that the key support that came in here at 43.90 was very key to the probability of this market coming in and posting higher highs and higher lows. It's been moving up very nicely, and we continue to be bullish on this crude contract as long as it continues to move in this nature. Thank you so much for joining us for our weekly market update.